the strategy that got you to 55 was correct. The same strategy will cost you between 55 and 75 if you keep running it. This isn't an argument for investing less. The total dollars you put away don't need to drop at all. What needs to change is the composition. 3 specific things shift at 55 that were completely irrelevant at 35, and almost nobody walks you through what they actually are. Here's the picture I want you to hold. For the first 30 years of your investing life, you've been sailing downwind. Sails up, push forward, maximize every yard of progress. At 55, you're approaching harbor. The same equipment that got you here will smash you into rocks if you don't change what you're using. You don't take the sails down. The work now requires anchors and mooring lines. The tools change because the phase changed. Today, I'm going to walk you through 3 phase shifts that happen at 55, whether you notice them or not. The specific math behind each one, and what to actually restructure if you're in the window. Investing more is not the worst decision. Investing more into the same structure is the worst decision. That distinction is the whole video. I'm Tom. This channel is about real personal finance for normal people. The kind that actually works instead of the kind that sells you a course. No motivational fluff. No fantasy returns. Just what the math actually does over time. If that's what you're here for, hit subscribe. Today, 3 phase shifts in how your money has to be managed after 55. The math behind each one, and the specific restructuring moves that turn the same dollar amount into a fundamentally different outcome. Phase shift 1. The tax structure that worked from 35 to 55 reverses at 55. For 30 years, the right call was to defer taxes. Max the pre-tax 401k. Cut your taxable income now while you're in your highest earning years. Pay later when you're presumably in a lower bracket in retirement. That math worked because the comparison was current bracket versus retirement bracket, and retirement bracket was assumed to be lower. That assumption breaks at 55 because 3 invoices from the IRS arrive between 65 and 73 that the original deferral math never accounted for. Invoice 1. Required minimum distributions. At 73, the IRS forces you to start withdrawing from every pre-tax account you own. The withdrawal is calculated by dividing your year-end balance by a factor from the IRS Uniform Lifetime Table. At 73, the factor is 26.5, which means about 3.8% of your balance comes out as ordinary income that first year. Then the factor shrinks every year after, so the percentage forced out climbs steadily through your 70s and 80s. You cannot defer it, you cannot delay it. The only 2 times in the last 25 years that the IRS allowed a 1-year skip were the 2009 financial crisis and the 2020 COVID emergency. Outside those, everyone pays. Invoice 2, IRMAA, Medicare Part B and Part D premium surcharges that hit when your modified adjusted gross income crosses certain thresholds. The first IRMAA tier in 2026 kicks in at $109,000 for a single filer and $218,000 for joint filers. Cross that line and your Medicare premiums climb. Cross the higher tiers and they climb further, eventually adding several $100s per month per person on top of the base premium. A forced RMD that pushes you across an IRMAA threshold drags Medicare cost with it. Invoice 3. Social Security taxation. Once your combined income, defined as your adjusted gross income plus half your Social Security plus tax-exempt interest, crosses $34,000 for single filers or $44,000 for joint filers, up to 85% of your Social Security becomes taxable. RMDs push combined income up. Higher combined income pulls Social Security into the taxable bucket. Taxable Social Security pulls combined income up further. The compounding is structural and the IRS designed it. Now meet Brian. He's 58, a civil engineer in Indianapolis, 26 years at the same firm. $1.4 million invested across his 401k and IRA, paid off house. Wife Karen, who teaches part-time at the community college. Household spending around $60,000 a year. By every conventional measure, he's doing well. His financial advisor told him this year to keep maxing the 401k, including the $8,000 catch-up, for the next 7 years until he retires at 65. Here's what the advisor didn't model. Most of Brian's invested balance sits in his pre-tax 401k and traditional IRA, Call it 1.2 million pre-tax right now. If he maxes 32,500 a year for 7 more years at a 7% average return, his pre-tax balance at 65 is approximately 2.2 million. If between 65 and 73 he avoids drawing aggressively from the pre-tax bucket and uses other assets instead, the balance compounds to somewhere between 3 and 3.8 million by 73. First RMD on that balance, somewhere between 115,000 and 140,000 of forced ordinary income in year 1 alone. Combined with his Social Security, that pushes him deep into IRMAA territory and pulls 85% of his Social Security into the taxable bucket. The restructure Brian's advisor didn't suggest, between 65 and 73, Brian has roughly 8 years of potential Roth conversion windows. In years when his ordinary income is lower because he's no longer working, he can convert pre-tax dollars to Roth at today's known tax rates, rather than at whatever future rates apply to forced RMDs. Filling up his current 22% bracket each year between 65 and 73 could shift somewhere between $200,000 and $500,000 from pre-tax to Roth at predictable cost, dramatically shrinking the RMD that arrives at 73. Same investment dollars, different tax envelope. The amount Brian saves doesn't change. The structure each dollar sits in changes. Phase shift 2. Volatility was your friend until 55. Now it's the largest single risk to your retirement. When you were 35 and the market dropped 30%, that wasn't a problem. It was a sale. Your paycheck kept coming. Every monthly 401k contribution bought shares at lower prices. The decline was a feature of your wealth building, not a threat to it. Compounding eventually recovered the losses, and then some. The math flips when you stop contributing and start withdrawing. The same 30% decline in year 2 of retirement means you're selling shares at the bottom to pay your living expenses. Those shares never get a chance to recover. The portfolio is locked into a smaller base, and every subsequent withdrawal hits that smaller base. The recovery doesn't bail you out, because you've already sold the shares that would have participated in it. This is sequence of returns risk, and the academic research on it is unambiguous. Returns during the first decade of retirement have the largest single impact on whether the portfolio survives 30 years. The exact percentage varies by study, but the structural finding is consistent. Bad early years matter far more than bad late years, even when the long-run average return is identical. Brian's situation again. He's at 1.4 million invested, roughly 70% equity. That allocation was right for the last 20 years. He had a paycheck, he could ride out drawdowns. The same allocation at 65, when he's retired and the paycheck stops, becomes a different animal. A 30% equity drawdown in year 1 or 2 of his retirement on a 70% equity allocation eats roughly 20% of his total portfolio value. If he's withdrawing 4 to 5% annually during that drawdown to live on, the math compounds against him fast. To put concrete numbers on this, run 2 simulations on a $1 million portfolio that earns the same long-run average return of 7%. In simulation 1, the bad years happen in the middle of retirement, years 15 through 20. In simulation 2, the same bad years happen at the start, years 1 through 5. Identical average return, identical withdrawal rate, identical total years. The first simulation ends with the portfolio roughly intact. In the second, the portfolio runs out of money around year 23. The difference is purely the sequence in which the returns showed up. Same dollars in, same average growth, completely different outcomes based on when the bad years landed. This is also why filing for Social Security at 62 for the right kind of retiree, which I covered in the previous video on Social Security claiming, can be the structurally correct move. The early Social Security income reduces portfolio withdrawal pressure during the highest risk window. Even with the permanent 30% reduction for claiming at 62, the 8 years of guaranteed income often more than pays for itself in protected portfolio value when sequence risk shows up early. The restructure for the portfolio side. A glide path that reduces equity exposure in the years immediately before and after retirement, then potentially increases it again later. Academic research calls this the reverse glide path. Hold 60% equity at 65. Drop to 40 or 50% for the high-risk first 10 years of retirement. After year 10, When the worst of the sequence risk has passed and the portfolio has either survived the bad scenarios or been spared them, equity can creep back up if the rest of the plan still supports it. This is not an argument to be conservative for the sake of being conservative. It's an argument that the right allocation depends on which phase you're in. Sails are right for the open ocean. Anchors are right for the harbor. Same boat, different equipment for different conditions. Phase shift 3. Set and forget worked, because paychecks were always coming. Set and forget breaks when paychecks stop. For the last 30 years, your portfolio's job was to grow. Liquidity didn't matter much because your paycheck handled monthly expenses. Emergency funds were small relative to total assets. Bond allocation functioned as a hedge against volatility, not as a tool for generating spending money. The portfolio could be 100% equity at 35, and the only consequence was sleeping less well during the drawdowns. After 55, liquidity becomes structural. You need accessible money that doesn't depend on what the equity market did in any given month. The cash buffer isn't a small percentage of your assets anymore. It's a tool that lets the equity portion of your portfolio do its job without being forced to sell at the wrong moment. Here's how the architecture changes. 2 to 3 years of essential living expenses in cash or short-term treasuries. This piece isn't yielding much, and it doesn't need to. Its job is to keep you from selling equities during the next drawdown. Another 3 to 5 years in a bond ladder, also reasonably defensive, providing income through interest payments and principal returns as bonds mature on a schedule you control. The remaining portfolio in growth-oriented equity, free to ride out volatility because the cash buffer and bond ladder are absorbing the short-term withdrawal needs. The bond ladder piece deserves more detail because most retirees never actually build one. A bond ladder is a series of bonds or CDs that mature on a known schedule, typically one rung per year for 5 to 10 years. As each rung matures, the principal becomes cash you can use for that year's expenses, and the ladder gets extended by buying a new bond at the far end if you want to maintain the structure. The yield curve usually rewards going out further, so longer rungs typically pay more than shorter ones. The structural advantage is that you know exactly when each piece of the ladder turns into spending money. Selling at a market price you didn't choose is no longer part of the equation. The 2026 rate environment makes this particularly worth doing. 5-year Treasury yields are sitting around 4%, which means a 5-year Treasury ladder built today locks in roughly 4% annual income on whatever portion of the portfolio sits in it. That's a guaranteed return between purchase and maturity, regardless of what the equity market does in the meantime. Combined with the cash bucket and the long-term equity bucket, the 3-bucket structure means Brian could weather a 50% equity drawdown without ever being forced to sell stocks at the bottom. The cash bucket and bond ladder cover years 1 through 8 of retirement spending. Equity recovers often within 3 to 5 years of a major drawdown. By the time the bond ladder is exhausted, equity has typically been rebuilt to or beyond its starting value. This is what the anchors do. The sails, meaning your equity portfolio, are still there. They still drive long-term growth across 20 or 30 more years of retirement. But the anchors hold position when the wind dies or shifts. Without anchors, every gust forces you to alter course at exactly the wrong moment. Brian again, he has roughly $80,000 in cash currently, which is about 1.3 years of his $60,000 annual spending. He's working, so the cash position is fine for now. By the time he stops working at 65, the architecture needs to look fundamentally different. 3 years of expenses in cash, meaning around $180,000, plus a bond ladder covering years 4 through 8 of retirement. That moves something like $500,000 to $600,000 of his portfolio out of equity into less volatile assets. The remaining $900,000 to $1 million stays in equity, doing the long-term work for the years 10 through 30 of retirement when sequence risk has passed. This isn't reducing the total dollar amount invested, it's restructuring what each dollar is doing. The pre-tax 401k Brian's been maxing continues to receive contributions if he wants, but within the larger portfolio, the share that needs to be liquid grows substantially as he approaches 65. The architecture is built before the storm, not during it. Then I should stop maxing my 401k? That's the obvious viewer reflex by now, and it's not what the math says. The math says the composition matters more than the amount. and the composition has to shift between 55 and 65 for the dollars to do their job. The total contribution doesn't drop. Brian still puts $32,500 a year into tax-advantaged accounts. What changes is where. Some still goes pre-tax to capture the employer match in full, but the rest gets split deliberately. A portion goes to a Roth 401k if his employer offers one, where the tax is paid now at known rates rather than later at unknown ones. Another piece goes to a backdoor or mega backdoor Roth IRA if he's eligible. The remainder sits in a taxable brokerage, where long-term capital gains rates and a step-up basis at death produce different lifetime outcomes than ordinary income on RMDs. If the company offers an HSA, that gets maxed first. The HSA is the only triple tax advantaged account in the US tax code. With the family limit at $87.50 for 2026 and an extra $1,000 catch-up at 55 and older. Pre-tax N, tax-free growth, tax-free withdrawal for medical expenses, which retirees typically use plenty of. The HSA at 55 is the single most efficient place a working dollar can land. The composition decision is what a good advisor should be helping with. Most aren't, because pre-tax 401k deferral is what their compensation models incentivize them to recommend. The fund family earns fees on assets under management. The advisor earns a percentage of those assets. Nobody in that ecosystem makes more money telling you to shift to Roth, HSA, or taxable brokerage. The recommendation defaults to what works for the recommender. The other reason the restructure rarely gets recommended, it's more work to implement than the default. Maxing pre-tax is one form, one click, one rollover decision. Splitting contributions across multiple account types, modeling Roth conversion windows across a 10-year horizon, building and maintaining a bond ladder, coordinating asset location across accounts. All of that takes thinking and ongoing attention. Most advisors are stretched across hundreds of client relationships and gravitate to default recommendations they can apply across the whole book. The default works fine for the firm, it works only sometimes for the client. 3 concrete actions if you're between 55 and 65 right now. Action 1. Model your Roth conversion window. Pull up your projected income for the next 10 years. Identify the years when you'll be in the 22% bracket or lower. Most retirees, between when they stop working and when their RMDs kick in, have a 5 to 10 year window where they're temporarily in a lower bracket. That window is conversion gold. Calculate how much pre-tax you can convert each year without crossing into the next bracket. Multiply by the number of years. That's the dollar amount you can shift from RMD eligible to Roth at predictable cost rather than at forced future rates. Action 2. Map your asset location across all the accounts you own. Bonds and high dividend assets belong in tax-deferred accounts where their yield isn't taxed annually. Aggressive growth equity belongs in Roth where compounding goes untaxed forever. Taxable brokerage holds broad market index funds that benefit from long-term capital gains treatment and the step-up basis at death. Most 55-year-olds have these backwards because the accounts were set up in a phase when the distinction didn't matter as much. Now it matters by 0.5% to a full percent of annual drag, which over 20 years is real money. Action 3. Stress test your plan against an involuntary exit at 60. Transamerica's most recent research found that roughly 3 out of 5 workers leave the workforce earlier than they planned. Most of the time involuntarily, with about 5 years of gap between the planned retirement age and the actual one. If your plan only works when you choose your exit, your plan only works for 2 out of 5 people. Run the scenario where you stop earning at 60 instead of 65. Check your cash buffer, your healthcare bridge to Medicare, use sequence risk exposure. If anything breaks, fix it now while you're still working. 5 extra years of earning income is the easiest 5 years to fix it in. The most useful outcome of running the stress test is finding the specific weak point. If your cash buffer can't survive 18 months of unemployment without forcing you to sell equities, you know what to build first. If your healthcare bridge to Medicare assumes ACA premium subsidies that you'd lose with even modest portfolio withdrawals, you know that's where the gap is. The stress test isn't an academic exercise. It's a map of what to fix in priority order while you still have a paycheck to fix it with. The financial industry has a built-in incentive to tell you to put more dollars into the same structures. because more dollars in the same structures pays the industry the same percentages on a bigger base. Reality after 55 is that the math you face is different from the math you faced before, and the structures that built your wealth aren't the structures that protect it. Total dollars don't drop. The composition changes. Roth conversions during the conversion window. Asset location across account types. Cash buffer and bond ladder built before the storm rather than during it. Sequence-aware allocation that reduces equity exposure during the highest risk decade and lets it back up once the risk has passed. Same boat. Different equipment for different waters. If this helped, hit subscribe. I'll see you in the next one.